Hi, I'm Peter Rose, founder of Longwood Currency Trading. I just wanted to give you some of my thoughts on retail Forex trading. And it's different than bank trading. What is the job of an institutional trader in the Forex currency market? It's not the same as a stockbroker or futures. It's different. The Forex market is a market of international currency exchange to facilitate commerce between two countries. I'm in the United States and I want to buy engine parts or something from Great Britain, and they're not going to take dollars to do that, so I have to sell dollars and buy pounds as the manufacturer. But I don't do that directly. I have to go to an institution. I have to go to JP Morgan or Chase or Citibank or something like that, and I have to say, and I call that trader there, or a broker who interacts with the trader, and I have to say, look, I need to sell $1 billion and buy the equivalent value in pounds so that I can purchase these engine parts. And they facilitate that. The Forex market is a $6.7 trillion a day market. It dwarfs stock markets, all the U.S. stock markets on a daily basis combined. And it's not going to go away because there's always going to be commerce between different countries, and different countries are always going to have their own currencies. And even if you take a block of countries and they block together and they form a new what they call reserve or default currency, which is currently the dollar, there's still going to be those exchanges that are going through. And even if they come through with a world currency, it isn't going to happen in your lifetime, and certainly not in mine. So we can trade confidently as retail traders, but we can't listen to the institutional traders telling us how they trade. Because as retail traders, we can't compete with the institutional trader. They've got a room full of PhDs in economics and physics and mathematics, and they're drawing up risk modeling and what-if scenarios and all this kind of shit, and they're putting this information out to their traders so that when a broker calls and says, I need to transact this $1 billion order or $400 billion order, these folks have their finger on the pulse of the economies of the two countries that are involved. They have dollar desks, they have pound desks, they have that's all those people do is trade in. So when the order comes in, they call the order desk and they say, give me a price on pound dollar. They're not telling them whether they want to buy or sell. They just give me the price. And the broker will quote them a price in a bid-ask manner. Bidding this and asking that. I'm 92, 94. There's a two pip spread there, and so that's the spread. So if you want to buy it, you pay 94. If you want to sell it, you sell it at 92. And then you tell them what you want, and they say done. But you're relying on them to get you that best price. How do they know what that best price is? How do they know what the market will withstand on your $3 billion order? Can we just drop that in the market right now, or are we going to have to distribute it in carefully over the course of a few hours or a few days, or maybe you have $800 billion order or whatever, or a series of them backed up, and you need to satisfy different clients, not just one client, but many clients. And you might have to spread that out over a campaign of several weeks or even several months. Because it depends on the pickiness of the client. How close to this perfect price are they willing to go, and what's their flexibility in that? If they don't, it's going to take the bank longer, or the institutional trader longer, to get that trade out. they're not dealing with individual trades. They're dealing with bid-ask spreads, and they're trying to get the best bid-ask spread. And they profit by that spread. That's how they make their profit. As retail traders, we're not profiting on the spread. The spread is what we pay to do the trade. You're going to pay a pip going in and you're going to pay a pip coming out. So it's going to cost you 2 pips. That's your spread. That's your cost. And so if you're trading a 10 lot at $100 a pip, it's going to cost you $200 to make that trade. That's what it's going to cost you. That's built in to the price. But do we need to worry about what the economic conditions are in the two-pair countries, or what what somebody thinks the unemployment rate is going to be, or whether there's going to be floods in a country, which is going to cause the country to print more money to pay for doing that, and that's going to reduce the value of the currency? Do you have to understand or know any of that stuff as a retail trader? And the beautiful thing of that is, no, you don't. You're not trying to make 30 pips, 40 pips, 100 pips. Well, you know, if you've fallen into the trap where you're setting long-term position goals, maybe you're trying for a couple of 100 pips. You're going to have to sit with that for several days. If you don't know when the next economic release will come out, news release of certain, well, whether it's an NFP or whether it's unemployment or new home sales or producer price index, which one of those is going to come up in the several days that you're going to hold that trade, and what effect is that going to have on your position? Depending on me knowing anything about the fundamental analysis, as they would say, what's going on in the pair countries that are going to affect price. I am marginally aware of the economic news releases from the standpoint of I got to know when they are, not so much what the implication of that is. I'm not trying to study economics here. I'm just trying to decide the effect that will have on the general market. I'm not trying to compete against the institutional trader. I'm just trying to let the dust settle, figure out what the institutional trader's bias is by what price action is telling me, not by anything about fundamentals or anything else. And I'm convinced that it should go in that particular direction. The only concept is how far will it go and when will it do that. That's the rationale that you need to be thinking about. And that's why I've broken the trading problem down into the life cycle of a currency position: entry analysis, position management, and exit methodology. Couldn't be any simpler than that. And yet, folks are trying to complicate this thing by trying to trade as a retail institutional trader. Retail traders are trying to trade like institutional traders because they're talking. You have to know all this fundamental analysis. You got to know all this. You got to know what the unemployment rate is going to do to the price of one of the currency pairs. Excuse me for moving it around. We have some wind that's starting to blow out here. We're going to catch some really severe storms later today, I think. This is getting on to the latter part of June of 2024. It's a beautiful day. I wanted to do this video outside and to be casual about it and to talk to you guys that are retail traders about being a retail trader. You can be successful, but you have to know about 4 key things, and one of them has to do with this risk management and what the risk management as a retail trader should be, as opposed to what an institutional trader's risk management should be. We use stops. Institutional traders do not. And so therefore the stuff that they're doing and moving large sums of money around, the rationale that they have for doing what they're doing and letting price move the way that they do, they're adding inventory as price moves against them, because they've got the fundamental analysis guys behind them that tells them what price from a higher probability standpoint than we can ever calculate is going to be. So you just kind of have to sit on the sidelines and wait until your experience shows you what you can do. And that's what my three rules, these three simple rules, do. They are retail traders' rules, which are really simple. I have one rule for entry analysis, I have one rule for precision management, and I have one rule for exit methodology. Each one of those rules has, on average, 2 conditions that need to be met in order for the rule to execute. In my first rule for entry analysis, I have 4 conditions. If any one of those conditions sequentially fails, I don't take the trade. If all 4 conditions throw a green flag, I'll put the position on. It's really simple. It's really simple. So if you're out there trying to do fundamentals and figure out what the unemployment rate is going to do to the price of the underlying currency, you're complicating things way, way beyond what you need to do. If you just step back from the screen with a couple of moving average lines on there, that's all you really need. What is price action doing? And how long do you think it'll continue for the 5 or 8 pips that you're going to make? Oh, okay, so you trade the mini lot at $1 a pip, and it's going to go 8 pips, I make $8 for the day. Or you're trading one full lot, it's going to make $80 for the day, but that doesn't pay your mortgage. Well, yeah, it would if you could do that every day, if you can get out of that trade and just make $80 a day. I mean, multiply that by 5 days, it's $400 a week. That's a full-time income, you know? But you don't look at it that way because you're levering it up and you're trying to make $600 a day, or what some of these fools are doing. They're making $4,000 a day. Yeah, but they're trading at 200 to 1 and they're leveraged out with the full load. So that's not you. You don't have a well to go to add more money into the pot to make that trade worthwhile. You've got to take small losses, learn your craft, so that when you finally get the entry right, it goes. And it'll go more than your profit target. And that's where you can add to it. If you're trading multiple lots, you have dry powder left. But if you put your whole load on up front, and you're trading at a high leverage, you're going to get wiped out really easily. If you go in with good risk management, short stop, you're wrong, so you get out. You're wrong, so you get out. You're wrong, so you get out. You're right. It goes to the profit target, you get out. And you've made 3 times more than what you lost. That's the game. That's risk and money management. You don't learn that by studying the fundamentals of a country. And you don't need that if you're looking at the chart and you understand order flow. And in the currency market, that's what makes life easy, is because we're looking at order flow. That's all it is order flow. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.